Hi and welcome to Swissquote's Daily Market Talk. It's Monday, January 27th, a week packed with big technology and other big company earnings, central bank decisions, and probably an avalanche of Donald Trump comments. Well, he's about to start with a 2% fall in Nasdaq futures due to some growing concerns out there that a Chinese AI startup called DeepSeek could disrupt the US technology dominance. And elsewhere, the US dollar is stronger this morning against most majors, while crude oil is trading lower. So tune in, we have a very busy week ahead. So high again from rainy Switzerland. US and European stock markets ended a bullish week last week that was marked by a smoothish inauguration for Donald Trump, an early pledge to invest as much as 500 billion US dollars in AI infrastructure from the new administration in the next 4 years, and very strong quarterly results from Netflix, remember? So that strong week ended on a bearish note as a series of PMI data from both sides of the Atlantic Ocean came on Friday to surprise investors because the numbers were above expectations, and the strong looking numbers, or the stronger than expected numbers, pushed investors to scale back the rate cutting optimism, especially in the US after Donald Trump's call for lower interest rates had boosted that optimism earlier last week. As such, while the Stoxx 600 index in Europe retreated after hitting a fresh all-time high, and the S&P 500 and Nasdaq 100 also traded lower on Friday's trading session. And futures, especially Nasdaq futures, are looking pretty bad this morning at the time I'm talking here, with a more than 2% slide, guys, in these Nasdaq futures on the news that a Chinese startup company called DeepSeek, could eventually disrupt the US technology dominance simply because they could run their latest AI model on less advanced chips, and that would be more cost effective. But keep calm and breathe, everyone, for a second, because the news are just some buzzy news from the weekend. They remain buzzy for now, and I think that is still too early to bet that the latter, so DeepSeek, will come anywhere close to the global leaders of the AI play anytime soon, even though there are some good remarks and good reactions to their new latest AI model. So I think that looks to me like investors are more willing to realize their profits before the announcement of some big technology companies than fundamentally DeepSeek itself, and DeepSeek gives a good reason to do so. Now, on the earnings front, 4 of the Magnificent 7 companies, Microsoft, Meta, Tesla, and Apple, and also the European ASML, are due to announce their quarterly results this week, but there is more reluctance right now than hope regarding the earnings, as the profit growth of these companies that are obviously confronted to very, very tough comparisons, especially for the AI-related ones, is expected to show the slowest pace in the past 2 years. In numbers, that makes the Magnificent 7 stocks eked out a 76% return in 2023. That was the first year of the AI craze, remember, but now are expected to print an earnings increase of 34% in 2024. That is expected to slow down to just 18% this year, according to Bloomberg. And if you pull the amazing Nvidia out of this equation, the remaining Magnificent 6 companies are just expected to print a 3% increase in their own profits in 2025. So obviously, that doesn't look very exciting for tech investors, especially at the current and high valuations. So there are pretty much 2 options for these valuations to come lower. Either the earnings will go up, or the stock prices will come down. And many investors out there actually bet for the second option. They expect that the technology rally could start showing weakness in 2025, and that we could actually see a further rotation from the big technology companies toward the more cyclical sectors of the US economy and also beyond the US market. So far, 16% of the S&P 500 companies reported their fourth quarter earnings and 80% delivered a positive EPS surprise. So let's see if this robust trend continues this week. Besides the four of the Magnificent Seven companies of the US, other big names like Intel, Visa, and MasterCard, and also the world's oil giants will be going to the earnings confessional throughout this week, and it will be a very, very big week of earnings, so be prepared. But it will also be a big week for central bank decisions, mind you, because the US Federal Reserve is expected to announce its latest monetary policy decision this week on Wednesday. And the Fed is set for an almost 100% certain no action, as the Fed members there will certainly want to just sit down, breathe, and consider the risks to inflation posed by Donald Trump's various MOC pro-growth, like growth boosting, and also trade restricting policies. So the US yields are softer this morning, mind you, on news that Donald Trump will eventually not impose those 25% tariffs on Colombia, as he said he would a few hours earlier before pulling it back. But the US dollar index kicks off the new week on a stronger ground with a rebound above the 50-day moving average. Now, despite Donald Trump's willingness to push the US Federal Reserve for probably unnecessary rate cuts to boost US economy, the US economy itself doesn't necessarily need a boost from the Federal Reserve, mind you, because the jobs numbers from the US economy keep coming unexpectedly strong. And also you have to note that the growth in the US remains robust, quite robust actually, thanks to solid consumer spending. So the fourth quarter growth update for the US economy will be released on Thursday this week and may show that the US economy grew 2.7% last quarter. That's slightly lower than the 3.1% printed at the latest update, but is still quite strong. And more importantly, the price pressures may have actually increased from 1.9% to 2.5% in the final quarter of last year. And the rising price pressures in the US, while growth nears 3% mark, is certainly not a favorable scenario, favorable mix for further rate cuts from the Federal Reserve. Across the Atlantic Ocean, however, here in Europe, the fourth quarter growth is due to be released a few hours before the US growth data, and unfortunately is expected to print a meager 0.1% growth in the fourth quarter of last year in comparison to the US 2.7% growth during the same quarter, giving the European Central Bank enough backing to cut the interest rates on the old continent, as long as the inflationary pressures here remain under control, of course. As such, the euro dollar that saw a decent rally last Friday and that could actually go and trade about the 1.05 psychological mark, looks pretty softish this morning. Levels above the 105 psychological level in the euro dollar remain interesting top selling opportunities for those investors that continue to bet that the growth gap between the US and the Eurozone economies and the diverging Federal Reserve and European Central Bank outlooks as a result of this divergence, as a result of this gap, hint at a sustained weakness in the euro rather than a sustainable recovery of the single currency. So the European Central Bank is expected to announce a 25 basis point cut this week when it meets on Thursday. And note that the European economies are obviously not flourishing, and they do need these interest rate cuts, and they do need this boost from the European Central Bank. And this is probably not going to be enough to boost inflation in Europe from the demand side. But the recent rise in energy prices needs some close monitoring, because crude oil prices rallied up to 20% between mid-December to mid-January, while the European natural gas futures jumped more than 25% over the same period and are nearly 120% up since February 2024 dip. So while crude oil extends a retreat this morning, also hammered by Another set of soft-looking PMI figures from China. Well, the pressure that we see in the European natural gas prices is real and will likely continue on the back of the geopolitical tensions with Russia and also cold winter weather in Europe and the falling natural gas reserves as a result of it, things that could eventually shift the European Central Bank's outlook toward a more cautious tone, could slow the urge to sell the euro, but not yet to reverse the bearish trend that we see in the euro dollar that will stay intact below the 106 Fibonacci level. Elsewhere, the Bank of Canada is also expected to lower its interest rates by 25 basis points when it meets this week. China will be closed most of this week due to the Lunar New Year break there. And finally, inflation in Japan, especially in Tokyo, that's due Friday, is expected to show a further rise to 2.5% level. Now, note that the Bank of Japan's decision last week to hike its interest rates and revise the inflation forecast higher didn't necessarily trigger a major move in the dollar yen. That's basically because most of the move was already broadly priced in. So the dollar yen tested but couldn't clear the 50-day moving average support, and the week starts looking quite supportive of further gains in the dollar yen. So this is all for this Monday. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.